With chaos at the New York Stock Exchange.
Get back in there at once and sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's gone crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Financial Advisor at BIG Investment Services. That's BIG, Booth Investment Group. We're a full-service financial advisory based out of Dover, Delaware, serving clients all across America. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come. Trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, October 25th, 2024. Shout out to Jeff, who's having a BIG kind of event this week. I hope that goes well. And I want to give a shout out to one of our own, to Tessa McDonald, our marketing director, T-Mac for short. She has been in full swing in the marketing department, doing some pretty awesome stuff and getting tons of feedback. So thank you, T-Mac, for making us look good out there on the internet and in the public eye. So let's jump into the numbers and tell you what's going on this week. It was a down week for the markets. No surprise here. We talked a little bit about that. I say down week. I should say mixed bag because most indices are down. The NASDAQ was up like 0.1%. But the Dow Jones was down quite a bit, down 2.6% on the week. You can thank a couple of earnings reports and issues for that. Verizon had a bad report. McDonald's, of course, they've been in the news with the E. coli outbreak there, and that stock got hammered this week. Boeing, their contract got voted down for the union, so that stock slipped again. So there's a few issues pressing, particularly on the Dow Jones. So it had a pretty ugly week, down 2.7%. But the S&P didn't do that well either, down 1% on the week. And the small cap index, Russell Small Cap Index, down 2.9%. Taking a look at the volatility index this week, it was up 12.7%, right at a 20.3. I think that can go higher, but right now that's where that sits. And then taking a look at long-term bonds, they were also down this week. And we got to talk about this. We're going to talk about bonds here in a minute. They're down 1.8% this week. Rates continue to go higher. And again, that's another discussion we're going to get ready to have here in a few minutes. So taking a look at the underlying sectors and what did what this week, it was kind of like down across the board, but I will say that the more interest rate sensitive sectors did more poorly. So utilities were down 1.9%, for example, financials down 2%, and then some defensives, healthcare down 2.9%, and industrials down 2.7%, materials down 3.7% this week, real estate down 1.5%. The only thing that really hung in there this week were semiconductors, technology. Technology was only down 0.2%. Semiconductors themselves were up 0.5%. Consumer discretionary up 0.6%. But just not a good week all the way around. And I would say that the more interest rate sensitive sectors took the bigger hit. And then we take a look at the metals. Gold was up 0.8% and silver was flat on the week. That didn't go anywhere this week. So what was moving markets? Well, earnings, number one. Earnings reports have been coming out, and I will say that they've been okay, but earnings revisions have been falling. The expectations moving forward don't look that great. The beats haven't been as strong and robust as they have been in quarters past. So there's a little bit of, I would say, some softness in there in the earnings reports at this point in time. The other news, we've had election talk and rumbling. There's been, I would say, indications that Republican GOP sweep could be in the cards, and the market doesn't like that a whole lot. The market does not like sweeps, okay? It does not like any one party having control of both the executive and the legislative branch because it puts the country at risk for things moving too fast, too much too fast. Gives them carte blanche to kind of do what they want, and markets get a little bit concerned about that. And then, of course, as I mentioned earlier, interest rates. So there's a lot of really weird friction happening right now in the market. It's really, really interesting to me on a number of levels. Interest rates continue to go higher, even though the Fed cut substantially a few weeks ago. So why is that? We touched on it briefly last week. We talked about inflation being a concern. And when you look at the economy, the economic news has been pretty good. It's been rather resilient. And Right now, the Atlanta Fed is estimating a 3.4% GDP growth for the quarter. Now, that remains to be seen. A lot of times the Atlanta Fed is wrong, but 3.4% is ridiculously robust, okay? So that's really reflecting a very strong economy in spite of inflation pressures over the last couple of years, consumers feeling pinched, credit card defaults higher, auto loan defaults higher, and so forth. So you have this stronger economic outlook. That's number one. And I think that the markets can start to be a little bit worried with a stronger economy that the Fed is not going to cut rates as much as anticipated, and also be a bit worried that inflation, which we have been mentioning month in and month out, is really being sticky at these current levels. As a matter of fact, we had a couple of inflation metrics that actually drifted a little bit higher last month. The market may be a little concerned that the inflation dragon has not been slain yet, and it could resurge and cause some serious problems for the bond market and interest rates. That's a concern. Then there's and I've talked about this in newsletters and I've mentioned it a bit here on the podcast, but I'm concerned about when the market wakes up to the national debt problem. And we could be seeing a little bit of that going on too, because the debt is in bad shape, folks. And I was listening to really sharp folks here earlier this week, Paul Tudor Jones, big time hedge fund guy, and just talking about where we sit right now economically with all of this debt and all of our current obligations. And if you look at history, folks, if you go back and you just look all throughout history, there's really only two ways to get out of this thing: to grow your way out or to inflate your way out. And sometimes that growth and inflation kind of go hand in hand. The market might be starting to sniff that out a little bit. The fact that we've kind of got our backs against the wall and we need to try to right the ship here with our national debt. And what that would look like would be the Fed trying to bring rates lower, even with inflation being, let's say, relatively moderate, if you will. And that's a big risk there. There's a real big risk there. It's a tightrope that is even hard to put into words, the type of tightrope you've got to walk to try to make that happen. But the objective being that you're going to try to keep enough liquidity in the system to keep the economy growing at such a rate that you can catch up and knock this debt down. Markets could be sniffing some of these things out. And then there's all the other things. There's the expensiveness of the market. It's getting really pricey, very, very pricey. We've been talking about that. I don't like these levels. Where we were looking at going into 2025, and not to get ahead of myself, we'll talk more about this in weeks to come, but we were looking to maybe add more to bonds. And I've talked about this to many of you and mentioned on the podcast, where we were looking to maybe add even more to bonds as a hedge to the market, because the market looks pretty rich here and earnings expectations, I think, have been softening a bit. That may not be the way I want to go right now, because there is like a lot of risk on both sides. Maybe recession doesn't happen. Maybe the economy hangs in, but maybe inflation becomes another issue and bonds don't perform well. These are things that we're having to grapple with right now and work our way through. The other thing really bothering me right now is the consensus on a couple of issues. There is tremendous, over the top, unbelievable consensus that this market's going to finish the year strong. I can't find anybody that disagrees. I mean, no one. That's concerning. And the market has not given us that ugly September, October that we normally expect to see in a presidential election year. Is it pulling those returns forward? Is the market already edging higher in anticipation, and then post-election, rather than getting a rally, we get a drawdown? That's possible. Another area of consensus that concerns me is for this no landing or soft landing narrative that's developed. Nobody's talking about recession anymore. Can't find it anywhere. And if you recall, a couple years ago, early 2023, that's all anybody was talking about. Everyone in the profession, everybody in the world was anticipating a recession and the market's going lower. The technicals of the market didn't look like they agreed with that narrative. We loaded up with stocks. Things worked out quite nicely. Now it's the other way around, and everybody seems to have the highest expectations for the market moving into 2025. So all of these frictions, just be glad you're not me having to figure this crap out. That's all I've got to say. So no, seriously though, what do you do when you have all of these competing narratives? You be diversified and balanced. That's what you do. You want to be diversified. You want to be balanced. You want to make sure you're hedging both directions. because you're not really sure which way these things are going to break. And I think in the short run, we're still subject to maybe some weakness in the market. Short-term indicators have definitely softened. So we'll see, does that short-term look like the next few weeks, or does it like the next 3 months? I don't know. We'll have to see. Either way, no matter what happens into 2025, the market returns are likely going to be muted. So we want to be hedging the market. At the same time, we don't want to go overboard on the bonds, because if inflation is not dead, if the national debt is becoming a problem, if the economy is staying strong and the Fed's not going to be cutting rates as anticipated, well, then maybe bonds don't perform as well as one might expect. So there's a lot of competing narratives. The way to work your way through that, to manage your way through that, is to cover all of your bases. Normally, we try to lean into convictions one way or the other. Right now, there's not a whole lot of conviction. So let's not lean any direction. Let's kind of cover our bases and maintain the balance. And I'll be looking too for some things that aren't going to be too correlated with either the market or the bond market to maybe act as a hedge in case things don't quite go well for either one. Because, we could have a situation with both the market and the bond market, stocks and bonds, are a little bit weak at the same time. And we want to make sure we're covered for that scenario as well. So that's what we've got going on over here, working overtime, trying to navigate. And of course, you say, well, David, everything's been fine, man. Markets keep going up. My statements are higher every month. And yeah, it's true. But see, we don't wait until the proverbial crap is hitting the proverbial fan. We want to try to be ahead of that happening, right? And be positioned before that takes place. We don't want to be caught unawares. So that's why I sound so intensely focused on trying to find our way through a lot of these competing narratives. And that's what we're focused on right now at BIG. And we will find our way through, because that's what we do here. So look, I'm going to go ahead and wrap up. Between now and next few minutes, you're thinking about your future, your long-term goals, all the things you want to do with you and your money. Maybe it's throw a big shindig for classic cars and airplanes. Maybe it is buy that second house, or pay for that wedding, or take that big trip with your family. Hey, you know what your goals are. Don't just think about them. Think big. Think BIG, and I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.